Okay, guys. So I have a one-on-one class with Renee and Drew, and what we're going to do in this particular class is we're going to readdress the liquidity issue because it seems like people are a little bit confused with what liquidity is, why is it so important, and how do we really um, use it, because a lot of a lot of times liquidity and support and resistance seem to be the same thing, and they are, but they're not at the same time. So when we talk about liquidity, right? We talk about liquidity. What is liquidity? Is liquidity, and why is it important? Why can't I spell? Because I'm dyslexic. All right. Okay. What is liquidity and why is it important? Okay. So to understand liquidity, we have to we have to really kind of like to understand its importance. We have to kind of understand how is it created, right? So I'm going to just get a paint up here. I'm going to actually just so what we're going to do is how is liquidity created? Okay, so there's a couple of ways that we can create liquidity. So in order to create liquidity, we have to understand what it is. Like, what is it? Okay. So liquidity is basically resting orders in its purest form. Okay. In its simplest form, it's resting orders. Okay, there is liquidity. There is a factor that's involved with liquidity in current orders, right? That will tell us some information. So what we're going to do first of all, though, is we're going to look at what's the difference between current liquidity and resting liquidity. It's kind of a it's kind of a you kind of need one to understand the other, right? Okay, so what is it? How is liquidity created? What is what is it? It's resting orders and its current liquidity, and how does that relationship play out about itself? Okay, so let's assume that we don't see the future. Let's assume that all we see is we're looking at a price chart. Could be any, could be any chart. It doesn't make a difference. Okay. There are two forms of liquidity that are playing on the market. First of all, how active is this stock? So current liquidity can be represented by volume, right? So if I were to look at AA, for example, during this day right here, the current liquidity on that day is very low in relationship to the current liquidity on this day, because it's represented by volume. Does that make sense? So you can see in a low liquidity environment where volume is very, very low, price tends to be very random, doesn't it? Right? Very random. But when volume picks up, you can see you get directional movement. Are you guys with me so far? Right? Doesn't mean you can't have directional movement on a low volume day, but you'll notice that the volatility on this move with this low volume is small. In other words, the range on this day was 2.9% on the lower volume. It was directional, but the range on this day was much, much higher because the volume was higher. It was 6.2%, right? But most of the time, the current liquidity, if it's low, will result in either a small range day with low volatility like these, okay? So how do we gauge current liquidity, especially for day trading? Well, very simply, we can look at a chart and we can say, are these candles making big moves? What's the size of those candles, right? So you can see the size of the candles right here are very large. But when volume dries up, so does the size of the candle. Now, what happens when you have a stock that's very thin? It looks like that. That means there's the current liquidity is very, very low, isn't it? In other words, there's no buyers or sellers that want to participate in this market. It's a very low current liquidity. Does that make sense? So we never want to lower the liquidity, especially for day trading. We want to avoid those types of markets and those types of contexts. Okay? We want to avoid that because the possibility of randomness increases exponentially, as we just saw, with liquidity. Right? You guys saw that on that daily chart that I just showed you earlier. The possibility of a directional move increases, a sustained directional move increases with higher current liquidity. Okay, do you guys understand liquidity, current liquidity, and why that's important? That's all you need to know. That's all you need to know. Those two factors. When the volume is higher and the volatility is higher, the probability of current liquidity making a sustained move increases. I think we did AAL. What was the first chart I had up, guys? I forgot. What was the first chart? Because that's where I did my drawing. I think it was AAL. Yeah, on a daily. Okay, there it is. So there's current liquidity, right? Now, currently right now, there is a market that exists for AAL. But you and I don't see it. It's called the order book. Okay? Banks can see it. Hedge funds can see it. If you are licensed and regulated to see the intrabank markets and the investment bank markets, there is currently a market that is existing on AAL, and that is future liquidity, or as we talked about, resting orders. So we can see the current liquidity of a stock, but there is also more liquidity, which is future liquidity or resting orders. So I don't know what that is right now, but I do know it probably looks something like this. And I'm going to go down to a smaller time frame to show it to you. It probably looks something like this. And the size of these boxes matters. So currently below the market on AAL, there are resting orders that will look something like this. Notice the size of these boxes that I'm drawing. In a perfectly balanced market, notice the size of these boxes that I'm drawing. Oh, copy that. Right, clone that. In a perfectly balanced market, the order book is going to look something exactly like that. Okay? That is what we call balance. And it almost always looks like that in a balanced market. And that's what that's what retail traders like to call range or congestion, right? Because you have an equal number of buyers and an equal number of sellers. Okay, change that color. You have an equal number of buyers and you have an equal number of sellers. Okay? So, this is where all life begins in trading. Okay? So, Drew asked a question. Can they see the order book size and price for the order? Absolutely. So, Drew wants to know, can they see the size of the orders and the price levels? Abso-fucking-lutely. And not only can they see that, they can see who it is. They can see that this big sell order consists of Goldman Sachs, Bank of America, and Merrill Lynch. And this big buy order consists of a bunch of retail numpties at small brokerage firms like Robinhood. So not only can they see the size, but they can see who it is. This is why it's so hard to beat the professionals in the market. Now, when I was a floor trader, I could see that too, right? On the floor, you can see that. On the floor, I could see that Goldman Sachs was buying at 1650. I could see at 1670 that Goldman Sachs was doing all the buying. I could see they were doing all the buying here. I could see they were doing all the buying there. Modern day floor traders can see it too, and so can the investment banks. That's why dark pools happen. Because dark pool, they're able to look at this large order, and let's say that Goldman wants to sell 20 million at 18, they can see that Citadel is offering 20 million at 18. So yes, they can see it all. Now in a balanced market, knowing who's where and knowing where the future liquidity is, it's pretty easy to exploit that, isn't that? So if I knew this information and I knew who was going to buy it, I knew my trade is very simple. My trade, in this case, drawing tools. One sec, guys. My trade in this case, looking for these drawing tools. Not a trend line. This stupid squiggly line. Sorry, guys. I found these drawing tools the other day and I'm trying to use them more. No, I lost it. Anyways, my trade in this case is to buy here and to sell there. If the trade goes further against me, buy more. Add to my trade. If the trade goes further against me, add to my trade. Average in, because it's a balanced market, right? So in this context, I can scale into this trade without too much problem. It's pretty easy to trade like that, right? But what if the order book didn't look like that? What if the order book was skewed one direction? What if there were buyers, but the vast majority of buyers were down here? And there were more sellers, and the sellers were more clumped around right there. What if that was the case? Would you adjust your trading plan? I hope so. Where's that stupid tool? There's a drawing tool, and I can't for the life of me find that stupid thing. Squiggly line. Just a squiggly line. This dumb squiggly line. No, that's not it. If you guys know, oh, there we go. For God's sakes. Okay. What if it looked like that? Then you would want to be selling here, leaning against those shorts and covering there into those buyers, and maybe buying there. And depending on what happened with this liquidity, what if all the sellers that were there disappeared? So what if the order book here, after, for goodness sake, guys, sorry. I don't know why it's not doing that, but what if this order book disappeared? Oh, that's why. I got to take this off. Forgive me, guys. I'm so sorry. Okay. What if this order book disappeared? So after you did this, after they sold that and they got there, what if that that liquidity disappeared? And the only thing left was this liquidity up here. Isn't this a great buy right here? You're leaning against all of those buyers. And now you've got an even better target all the way up there. That make sense? Well, I can't turn that off. It's beyond me. So knowing liquidity and where it most likely is to be resting is the key to knowing what the future. Does that make sense, guys? Okay. Knowing where liquidity is the future. Okay. So we can't see the order book, can we? We can't see the order book. But by using everything that I taught you in following the order flow tracker, we can make some assumptions, can't we? Right? By knowing the footprint of what the professionals did, they can hide the future from us, but they can't hide the past. That's why learning order flow is so critical, especially the way I teach it, to knowing the future, because you can make some assumptions about where liquidity should be resting. And based on this order flow, would you guys all agree that there probably is a bunch of buy liquidity sitting right here? Probably. And there's probably a bunch of sell liquidity sitting up here. And it's probably less than the buy liquidity. Well, how do you know that, Steve? Well, I ask myself a question. If I was long this market from this level, where would my stop be right now? Probably 1580, right? What if I was long this market from this level still, and I wanted to lock in profits? Probably a little bit higher, probably somewhere in there. What if I was long this market from this level, and I wanted to lock in profits? That'd probably be about here. What if I bought this breakout? Well, I don't want to lose money, so I put my stop at break even. What if I was long from this level? Well, I don't want to lose money either, so I'd probably be somewhere around there. So I can make a pretty good picture just based upon anybody that's big that's still in this market where their liquidity is going to be resting, just by making some simple assumptions. What if I was long from this level? Well, I don't want to lose too much money, so my stop's going to go about there. What if I was long from this level? Again, I don't want to lose too much money. My stop's going to go there. But what if I was short from this level? Well, I took some heat, but now my trade is doing okay. So I can give that trade some room to breathe. So maybe there's going to be some liquidity sitting in here. What if I was short from this level? Well, I'm a lot happier, right? So there's probably going to be some liquidity there. But it's going to be a lot. It's going to look more like this, because the number of longs that are protecting profits or want to add to their trades is much larger than the number of shorts in this trade. Because anybody that's short from here probably stopped out. Anybody that's short from here, they're stopped out. Anybody that's short from here, they're probably stopped out. Anybody that's short from here, they're probably stopped out. So these are really the only shorts that are left in this market. Does that make sense? So we built this liquidity model based upon following the order flow. And making some simple assumptions. Right? So liquidity, we could never really know, but we can get some really good ideas. So what do I want to be doing if that's what the order book looks like? If I told you I knew what the order book looks like, if I make some assumptions about what I think the order book will look like based upon me putting together the order flow and basing liquidity issues here, disappeared on me again. That stupid tool disappeared on me again. Where the hell did that stupid thing go? Is it just me? Am I losing my mind? The rectangle? There we go. Okay, thank you. Now I can make some assumptions, right? Now I can wait to see what happens at this liquidity. Do they buy it? Well, I might want to buy that. And then I'm going to lean against this big liquidity here, and I'm definitely going to be buying there. And my target is going to be this liquidity here, and maybe even this liquidity there. So that's how I design a trade. So you might say, Steve, well, what about, is liquidity value? Hopefully. Hopefully. hopefully you have liquidity and value at the exact same place. Because that trade, if it's at liquidity and value, is going to be unstoppable. It's going to be perfect. Right? So this is life in a vacuum. This is life in a vacuum. And if markets were that easy, I would own Fiji right now. Markets are never that easy because new information is always coming into the market, right? And price is always changing. And liquidity is always being tested. So liquidity will move around depending on what happens with the price. Maybe when this happens, liquidity shifts higher. Maybe when that happens, liquidity goes higher. Maybe this liquidity disappears. So liquidity, as the name suggests, is very fluid and changing. And it will change, and orders will be lifted and removed based upon news, based upon new fundamental changes, based upon Trump getting elected, based upon the price of tea in China. Lots of things will affect price movement, and liquidity will be removed and added as price moves and new information comes into the market. But understanding where liquidity is most likely to be and why it's important is really, really, really important. So why is that liquidity important? It brings us to our next question. Our final question is, why is liquidity important? Oh. Oh my God, guys! I am such a I'm such a technical mess today. I wanted to do that and draw, but why is liquidity important? Right? Why is it? Okay, let's address that question. So let's go build a scenario now where we think we have the liquidity that we do. Let's say we were right and there's a ton of liquidity sitting here and just a little bit of liquidity, sell liquidity sitting there. And let's say there's a little bit of liquidity sitting there. Okay, so let's say that's the case. Now let's say I'm a large institution. Let's say I'm sitting on the desk and my boss walks up to me and says, "Hey, we just got this big giant order for 20 million shares." That might be an exaggeration. Let's say 20 million. Let's say 5 million shares. AAL. So you just got that order. 5 million shares. You have to fill that order. There's demand for AAL. Now, what would happen if what would happen if the current, let's go back to the current liquidity. Remember, low volume day? What would happen on a low volume day when the current liquidity was low or volume wasn't there and you had to fill a $5 million buy order and the order had to take place right away? You're going to push that price straight up, and the second that you fill your order, price will come straight back down. Does that make sense? So if you try to fill a large order in a low liquidity environment, you are going to become the market. And the second that you disappear from the market, price will just return. Now, what if you were the guy that got that 5 million share order and you filled that order with an average price of 60, and at the end of the day, you filled it with an average price of 1460, and at the end of the day, it was 1422. Would your boss be happy with you? He'd probably be pissed, and you would lose your job. So to large traders, knowing where liquidity is really, 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 really important, because they want to use that liquidity to their advantage and to their client's advantage. So what if I knew price was $17? This is a bit of a stretch, but let's adjust it a little bit. What if I knew the price was $17.60 and there was a massive liquidity to buy between 1660 and let's just make it more realistic, and 1618? What if I knew that? And what if I knew that it would cost me, let's say it would cost me 200,000 shares. If I short 200,000 shares, could I push the price down to where that big liquidity was resting? That would be a great idea. Yeah, it's going to be risky. I'm going to have to short 200,000 shares, but I'm going to be able to get filled a big chunk of my order down here. And because there's no sell orders above the market, it's going to be very easy for that order to fly. You understand that? This is why knowing where liquidity is extremely important. This is why Goldman Sachs had 2 losing days in 2019. That's it, 2 losing days. Because they know where all of this is, and they are the market. Or a company like Citadel or BlackRock. So what we have to do by understanding the significance and importance of liquidity and making the assumptions correct by following everything else that I teach you in my order flow class, how to do the order flow, where are the pressing limits, where's liquidity, and then by getting this right by everything else that I teach you, liquidity and the significance of it becomes really, really important because it allows you to design your trade successfully. Okay. So I showed you a simple way that you can make assumptions on liquidity. But the better you get at figuring out the story and putting together the entire context, right? If it was only that easy. By putting together the entire institutional context, hopefully, specifically the way I teach it, right? By taking my course, by putting together the entire institutional context, you can build a better model of liquidity and value. And therefore, plan your trades out better. Does that make sense? So liquidity is important, very important. But putting the context together, what's the overall market doing? Where are the pressing limits? Where's value? Is value at liquidity, or is liquidity higher than value? You can time your trades perfectly and increase your probabilities of success dramatically. Any questions, guys? So, are you going to be an expert at finding liquidity right away? No. It's part art, part science. You can make some assumptions, but we can't know if that guy has a 5 million share order to buy AAL. We can never know that, right? But we can make some assumptions based on value that there might be an order there. We can make some assumptions of where stops and resting orders will be. We can look at the current liquidity, and that will give us a good idea. We know what that is. That's we can see that. Part art, part science. And that's why I always tell you guys, it's going to take me a year to turn you into master traders. It's not one little trick that I'm going to give you today or tomorrow or a trend line or any of that shit or a moving average. That's going to turn you into a long-term successful trader with 40 years of experience. It's part art, part science, putting the context together, coming up with a thesis, creating a trading plan around that thesis, and then boom, plan your trade and trade your plan. And this could be a 1-minute chart, a 15-minute chart, a daily chart. But that is the significance of liquidity. All right. Any questions, guys? Couple questions. Okay. 1, is there any significance on how to draw liquidity, covering candles or anything like that? 2, how can we tell when liquidity is exhausted? You can tell, good questions. You can tell by the reaction. So that's actually a really good question. So what if I assumed there was some liquidity sitting right here? What if I made that assumption that there was liquidity at 1640? Now let's play 2 scenarios. What if this scenario worked? We thought there was liquidity here, and price had that reaction. And now we're thinking, should we take profits here? What if it cuts straight through it? There's nothing. But it pauses maybe for 1 or 2 candles. But then just keeps going. Then we can make a very good assumption that we will go to that liquidity. And what if it cuts straight through that liquidity? Then we can make a very good assumption that it's going to get that liquidity up there. That makes sense? A pause or 2 is okay. But what if it's different? What if it's a different scenario? What if, better than that, what if we get to this liquidity, we react off of that liquidity, but boom, there's a reaction off of that. It looks something like that. Well, we can make another assumption, can't we? we can say that maybe we were wrong about that liquidity. Maybe there was more liquidity there. Remember this saying, it's critical, critical, critical to your understanding success in the market. The only reason markets move is for to seek out the next liquidity level. We don't know what's at that liquidity level, but markets move from liquidity to liquidity. Just think about it like you were at a car auction. Imagine you were at a car auction and there was a 63 Corvette on the block. Love this 63. Such a beautiful car. Okay, so they roll in this beautiful 63 Corvette. Now, what is the auctioneer's job? What is the market's job for this 63 Corvette? Go ahead, take your guess, answer the question. What's the auctioneer or the market's job for this 63 Corvette? So the answer is get the most for it. Absolutely. Absolutely, to get the most for it. But how do you find out what the most is? What if you're in the middle of a recession and nobody's spending money versus the middle of a booming time when liquidity is very high and the Fed is pumping, the market's full of liquidity? Are you going to get more during a booming liquid time for that than you are during the middle of a recession when money is scarce? Damn right you are, right? But how do you figure that out? Liquidity answers that question. So what if the auctioneer stop it. What if the auctioneer, okay, starts out the auction process? So they started the car at $17. There was no offer. He says, 17. Do I hear 17? Do I hear 17? Do I hear 17? Nobody says anything. Do I hear 1690? Do I hear 1690? Do I hear 1690? Nobody says anything. Do I hear 1680? One guy says, I have 1680. He drops it down to 1660 and 50 guys, buy, I want to buy. 50 guys start buying at 1650. Huge demand. So what's he going to do? Is he going to say, no, sold, if 50 guys start wanting to buy? No. He's going to say, well, it's 1672. Buy. There's 40 guys that want to buy. What about 1696? There's still 30 guys that are willing to buy it at 1696. What if he gets it up to 1640? And now there's only 2 guys left. You understand? Markets, whether it's a car auction for a market for a car, or whether it's a real market, do the exact same thing. They bid and offer prices to find out what the supply and demand is for that market. Now, if we get to 1639, there were originally 50 guys right here. What if the same 50 guys are still here? It's going to go to there, isn't it? And what if there's only 40 guys that are still happy to buy at that price? It's going to go there. That is what a stock market is, guys. Markets seek out liquidity. And it's going to go from here to here relatively quickly, isn't it? If there's nobody in between here, the 1740 price and the 1860 price, if the liquidity is low, the current liquidity is low, it's going to get there really quickly, isn't it? But what if there was a bunch of liquidity in here? If there's a lot of liquidity in here, it's going to take longer to get there and probably exhaust most of those 50 buyers that were down here. Does that make sense? So understanding the reaction at perceived liquidity is key. That's all algos do, guys. All an algo does is it measures the buying and selling pressure of the resting liquidity versus the current liquidity, and then it watches what happens when it gets to the next liquidity level. Do these buyers disappear or increase? Do these sellers make a heavy influence on that price and push it lower again? So knowing where liquidity is important, but seeing the reaction and monitoring the reaction at liquidity tells us a whole different story. And that's what your order flow tracker teaches you, doesn't it? Because by looking in hindsight, we can look and see what happened at liquidity and what was the reaction. And that builds the context of what is most likely to happen in the future. You guys understand that? So both of you guys are like just at the beginning at the course or close to the beginning of the course. The first step to learning how to use this information is learning how to plot it successfully. So what I want you to do now is I want you to go back out there, continue to do everything else that I've taught you, and then plot it on your charts and show me where you think it is. And then by experience of watching it over time, putting together the right context, you'll get better and better and better at it. Give me a year of your life, and I will give you a 40-year career. But there's no shortcut. Okay? Any other questions right now? All right, guys. So that's it. That's all. Get back to work. Get back to your homework. Okay? Thank you, and I'll look forward to your homework this week. Bye for now.